Good morning, everybody. It's 10 o'clock on Tuesday, January 18th. Welcome to January 18th. Good to see you all. We have a lot coming up. As I always say, we've got a lot coming up for you folks, and we've got some really interesting information that's come out over the past 2 weeks. We're seeing inflation reports again. I'm going to talk about both the consumer price index that came out, I guess, late last week, the producer price index, which is kind of what we call a leading indicator of what is likely to happen. I'm going to, a little bit of a spoiler, they're both higher. So we're going to talk a bit about that. There's a lot of feelings we talked over the past few weeks, or actually we've been talking over, close to more than a year now, about the cost of inflation and what inflation does to the markets and how that could potentially drive things. So we're going to have an interesting view from Mr. Byelich from Prudential and some other analyst reports. So let's get into it. So first of all, if everyone, can you hear me okay? Just raise your hand if you can hear me okay, please. All right, very good. Thank you. Again, good to see you all. All right, so we're going to go over do some slide updates like we always do, just to give you the layout of the webinar. A lot of folks are viewing these recordings now, so you'll see. First of all, we'll do some slide updates, and then some market updates, and then we'll do a financial planning topic in the last few minutes, 15 minutes or so. And this topic this week is going to be how to invest in a down market. So I meant to do a poll, and I should have done a poll about how you feel about the markets this year, but I'm willing to bet that most of you would raise your hand and say, well, I think markets are going to not have much growth or potentially be down. And I gave you my thoughts last week. That's exactly where I think we're going to be. I think we're going to potentially see a down year or very, very little growth, but we don't want to invest with that mindset of listen, if it's going to be a down year, let's just stick it in cash, because we can always be surprised. We were surprised last year. We've been surprised before, but don't forget, we are coming off of 3 years of really strong growth. The S&P 500 has doubled in the past 3 years. And it's just very likely, with all the pressures that we have, that we're going to see some troubling times this year, and we need to invest. We need to stay invested, and we need to invest appropriately. So we're going to talk a bit about how to do that and how to build that foundation. What we have coming up is, and I want to remind you that everyone is muted. There is a Q&A available at the bottom of the screen. Your chat should be disabled, and you are, of course, being recorded. Tomorrow night, David McKnight is joining us live at 6:30 p.m. So that's Wednesday evening, January 19th at 6:30 p.m. You should have all received an email invitation. We've got quite a few people registered already, and that continues every day. So I send these email invitations out, as you've seen, every day or every couple of days. It starts with every couple of days, and then I like to remind you every day leading up to the event. I just want to make sure that no one can say, hey, I didn't get that. So David's always great. I've been catching up on his podcasts, last 3-week podcasts I listened to over the weekend. If you're not listening to the Power of Zero podcast, you're really missing out. There's such great information on there, and it really just reinforces what we work so hard to do, and that's drive you towards tax efficiency and stabilize your investments and make sure that you're set up the right way, but mostly that tax efficiency that is so vitally important. We also have David joining us live on April 27th. So April 27th, he'll be here live. I'm working on the venue. I think I have a great place. There's some issues around the sound, but we're working through it. We have a bit of time. And for you folks, we're working on a VIP event just for you folks who are clients and who join us on a regular basis. And I'll give you more about that. Okay, so I'm going to just talk a little bit about the headlines. The big headlines, of course, are the consumer price index and the producer price index. So consumer price index roughly is inflation. So I'm going to share with you, let me find the right screen here. And again, you can access this. This is not what I'm going to share with you is the report from the Bureau of Labor Statistics. You know, you can sign up for the emails if you want to, and you get notifications, or you can just go to bls.gov and look at these reports. But let me share my screen with you, and you can see what we're talking about here. So just raise your hand for me if you can see my screen, and it says, I'll take you up to the top, U.S. Bureau of Labor Statistics. Thank you. So we'll see here that all items, you see all items, and it gives June, July, August, September, October, November, December, and these are the amounts that those items increased in each month. So the unadjusted 12-month ending December 2021 is 7%, so up from last month, which I think was 6.9, so up slightly. But, you know, quite a trend here. And you'll see as we move down, food is up 6.3%. Food at home is up 6.5%. Food away from home is 6.6%. Energy, 29%. Energy commodities, gasoline, 49%. Fuel oil is 41%. So, you know, these are big costs, and we're just rolling into the real cold season. You know, we just had our oil tank filled. I wish I could get away from oil somehow, but can't do it where I am. And I don't know, other than, you know, just heating all with wind power or solar. I don't know if natural gas or any of that is going to be much better, but you'll see new vehicle prices. So you can break that down. So this is, of course, reported each and every month, and we're going to continue to see these high numbers for some time, in my opinion. So it's good to know what's going on out there. So let me stop that share. And the producer price index is the cost generally of making these goods. So what people are paying for to make the things that we consume. The producer price index was up 9.7% in December, or for the year, right? But the year ending December. So that tells me that this trend of increasing is not going to slow anytime soon. We've been talking about it for some time, but you know, we've got to keep our pulse on this and have us set up accordingly. The hard part, we just made some adjustments in our financial planning assumptions and took the average over the next, you know, several decades up to 3.5% instead of where it was at 2.4%. Now I'll tell you that plans will start to fail. Just that 1.1% plans will start to fail. So this is why it's important to review these plans every single year. I don't anticipate that we'll have a lot of plans fail, but the folks who are right on the edge, who don't have a significant amount in our legacy longevity portion of their funding, you know, they could see some troubling times. Okay, so let's get into the Ed Slott updates. I don't see any questions about what I just talked about. The first one comes from Sarah Brenner, and this is a good one. What to do if you missed your 2021 required minimum distributions. So we all know that everybody, when you reach a certain age, right now it's age 72, you're required to start taking money out of your IRAs. Even if you don't need it, you have to take it. You must pay tax on that money, of course. And inevitably, someone contacts us and says, you know, I was working with so-and-so. We didn't take an R&D last year. We were supposed to. How do we correct it? And this happens not with our clients because we stay on top of it. I will admit it going back several years ago, it happened. And we've corrected our structure now to make sure it never happens again. But it happened with one individual. But we corrected it, you know, made sure that everything was good for the client. But these things happen, and we get questions about it each and every year. Somebody forgets to take their required minimum distribution. So Sarah starts out, did you take your RMD, required minimum distribution, from your IRA for 2021? Hopefully the answer is yes, because for most IRA owners and beneficiaries, it's not only if your own IRA, but if you're the beneficiary of an IRA, remember, and it's under the prior to Secure Act guidelines, you have to take a required minimum distribution every year. There is an exception. If you reach age 72 in 2021, you still have time. Your deadline for taking your 2021 required minimum distribution is April 1st of 2022. You can put that off until that required beginning date of April 1st, 2022, if it's your first one. So if you turn 72 in the year in 2021, you can wait till April 1st in 2022. It usually doesn't make sense to do that. Sometimes it does. So the end of the year is always a busy and stressful time, she writes. You may not have gotten your RMD out in time. If you missed the RMD deadline, statistics show you're not alone. Government figures show a surprisingly high number of IRA owners fail to take their RMDs. Many people miss it year after year after year, and that becomes problems and sometimes problematic. And I talked about it a few weeks ago when I was showing you the new RMD chart, which is uploaded on our website now, but it hasn't yet passed the gate of compliance review. So I checked on that this morning. So hopefully it'll be this week. Everybody's been out sick and things have been really slowed down, it seems to be, as far as response time. Everything seems to be taking a little bit longer. But if you miss your RMD, there is a 50% penalty assessed on the amount that should have been taken out. So for example, if you had a $10,000 RMD due for 2021, you'd be subject to a $5,000 penalty. So here she lists the things that you could do. This is a relatively long article, so I'm trying to just give you the bullets here. If you missed the RMD, the IRS can waive the 50% penalty for good cause. Here are the steps you will need to take to have the penalty waived. You have to take the RMD. You've got to get it out of the IRA. So take your RMD, take the distribution. You have to take the amount that should have been taken. File the 2021 IRS Form 5329. So IRS Form 5329, that's additional taxes on qualified plans, including IRAs and other tax-favored accounts. When you file this return, you don't have to prepay the penalty, but if the form is filed without the payment of the 50% penalty and the IRS later determines that the penalty is owed, you could owe interest and penalty on that amount. Form 5329 must be filed to start the IRS statute of limitations clock. So this becomes important later on. Attach a letter of explanation to the Form 5329. So when we had the error, and it was our error, we wrote a letter for the client. The client attached it to the 5329, said it was our error, and the IRS was fine with that. The letter should include the reason why the 2021 RMD was missed, the fact that it has now been taken, and the statement that you have taken steps to ensure the future RMDs will be taken on time. So you have to do a little bit of mea culpa. I made this mistake. It'll never happen again. I'm making sure that doesn't happen. After submitting your request, you must wait for the IRS response. That's always fun. The IRS may respond to your waiver request within a few months. If you have not heard from them in 3 years, that means they've granted the waiver. So no news is good news. If you don't hear anything for 3 years, then you've granted the waiver. Getting a waiver of the 50% penalty for failing to take your RMD may seem complicated and time-consuming, but it can be worth the effort. Many taxpayers have had successful results. It's probably one of the most common things that I see waived. So when people call with a panic, oh my gosh, what am I going to do? I missed this. Is such a big, some required minimum distributions are $20,000, $30,000. That's a $15,000 or $10,000 is a big penalty. Listen, $1,000 is a big penalty. So people call very panicked. Most of the time I've seen that these are, I can't think of one that I've ever seen that hasn't been approved. If you have questions or need assistance with the process, it's always best to contact a knowledgeable financial advisor or tax preparer for your advice. You don't mess around with this. I've seen it on the other side too. I witnessed somebody whose CPA just flat out told them, nope, you just have to pay it. You missed it, you have to pay it. There's no way of getting around it. And that was just horrendous advice, and cost that CPA's job. But how about QCDs? So qualified charitable distributions. These have become very, very popular. There are some things you have to watch out for with qualified charitable distributions. This is a way to take your required minimum distribution and send it right to a charity without paying tax on it, right? It's like going, not pass and go. You send it direct, must be directly to the charity. We're going to talk about the details, and then you don't pay tax on that money. So if you're charitably inclined and you're concerned about paying tax on your required minimum distributions, then this is a way to avoid that tax by funding a charity. This is a really, really great tool for calculating Roth conversion. So when you figure, if you've got a bucket of money left at the end of your life, or an allotment of money left at the end of your life in our legacy longevity identification, and you say, you know, I probably won't need this money. What's going to happen is I'm going to send it to a charity. Well, you don't want to convert that money that you're likely to send to a charity because you're paying tax on something that is never going to be taxed. So one of the ways that we handle that during your lifetime is we do these qualified charitable distributions directly to the charity if you're charitably inclined. Listen, if charity isn't your thing, that's okay. QCDs aren't for you. So QCDs are only available to IRA and inherited IRA owners who are 70 and a half and over. So there's a little disconnect in the rule, right? 72 for an RMD, but you can do a QCD at 70 and a half. It's capped at $100,000 per person per year. For a married couple where each spouse has their own IRA, each spouse can contribute up to $100,000. QCDs cannot be done from employer plans, so no 401ks, no 403bs, can't do it from there. Only applies to direct transfers, IRAs, and charities, and not gifts made to private grant-making foundations, donor-advised funds, or charitable gift annuities. Some people try to get kind of fancy with this, and it's got to be direct to a qualified charity. No deduction can be taken for the charitable contribution, and nothing can be received in return for the donation, like you can't get a t-shirt or a tote bag. We suggest doing QCDs early in the years to avoid any conflict with the first dollars out rule. This is where people get stuck. What is the first dollars out rule? The first dollars withdrawn from your IRAs are deemed to be an RMD. When you're in RMD age, whatever you first take out is going to be deemed as your RMD. They have rules. The IRS has rules about funds coming out of accounts. If an IRA owner is looking to offset the income from an RMD with a QCD, those transactions must be done in conjunction with each other. You've got to plan it out. You cannot take an RMD payment and then decide to retroactively do a QCD with those same dollars. You can't say, well, listen, I've already taken my $50,000 RMD. Now I'm going to count that as a QCD. You've received the funds. You can't do that. As mentioned in the facts above, QCD only applies to direct transfers to IRAs to charities. QCDs can be done after an RMD is taken, but the QCD will be an additional distribution on top of the RMD. The first dollars out rule is not the only pitfall that can disrupt the QCD. Some IRA accounts are allowed check writing privileges. We don't have any of those, but they can be. If the check is written directly to a charity, that's okay. It can be a valid QCD. The problem is that some people wait till the end of the year to write those checks. So your date might say 12/20, but the charity doesn't deposit those funds or reconcile those funds, really deposit them until January. Let's just say, well, you've got a situation, right? Because your QCD has to be done at the end of the year. The Secure Act, one final QCD pitfall to be aware of: the potential for a QCD to be taxable. That's not good. We know the QCDs are used to exclude the donation amount from income. However, there is a situation when the QCD can be a taxable distribution. The Secure Act eliminated the 70 and a half age limitation for contributing to an IRA. So you used to, after 70 and a half, even if you're still working, you could not contribute to an IRA. That's eliminated. Now you can still do that. But if you have earned income at any age, you can now contribute. But if you're 70 and a half or older and make a deductible IRA contribution, any following QCD up to the amount of the deductible contribution will be taxable. So if you put $7,000 into the IRA, make a $100,000 QCD, $7,000 of that QCD is going to be taxable. The amount of the deductible contribution will offset the same amount of the QCD, no matter how far into the future the QCD is done. As such, our recommendation is to not make deductible IRA contributions when also doing QCDs. Consider a Roth contribution instead. I don't think there's a client of ours that would do a traditional IRA contribution at that point. But that's our slot information for today. And we have a question. Let's see. Kathy, hi. Kathy writes, is there a minimum amount for a QCD distribution by regulation or suggested amount that makes financial planning sense? Well, Kathy, you're not going to be surprised to hear my response to say it's different for everybody from a financial planning sense point of view. So when, and there's no minimum, right? There's no minimum amount that you can send to the QCD. I'm sure there's you know, you don't want to do $1 or it has to be impactful some way. but it is absolutely going to be different for everybody. So if you and your husband both wanted to make QCD contributions, you would work through really the plan about drawing those down and what made the most sense. And it's a really, really valuable tool for reducing the amount in IRAs. Now, remember, we had a significant growth over the last 3 years. What we've been chasing is the growth of IRAs while we're trying to convert it. You know, if we have a down year this year, as long as you're set up okay, this can be a real let's make lemonades out of lemons. You can you start shoveling more money, right? Get more value for those Roth conversions, because we do know that the market's going to recover over time. The question is, what's that time? So to answer your question, Kathy, it's different for everybody. That's why you have to work through these things, and you have to review them every single year. I hope that makes sense. Okay, let's close that out. Good question, Kathy. Good to see you. All right, we are no longer sharing. Okay, so now I want to do something a little bit different for you. You know, I've considered not doing webinars with after holidays, Tuesdays after holidays, because a lot of my information I rely on isn't available on Tuesday mornings, like the weekend, the week ending market reports. And that was the case this week. But here's what I did for you. As I said before, I like to show you things that you can do yourself. So let me share my screen again. And I just want the Market Watch. So, you know, Market Watch is kind of my go-to for just quick and easy information. I've shared with you before. I've got all these different research tools and quote tools, you know, but Market Watch is just so darn easy. So I like to go here. I like to see what's going on. Look at this. The Dow Jones Industrial is down 500 points today. The NASDAQ is down 188 points. So this is, you know, this is significant movement. And we're going to talk about investing in these negative markets and what could potentially be happening. But let me show you what I did here is I just threw in some of the broader indices, right? Some of the things that we track on a regular basis that kind of give us a snapshot of where the markets are, where they've been, and no way to know where they're headed, right? So if you look at this, what I have here, I'm showing, if I move this, it's going to move, but I have the US AGG. So that's an exchange traded fund that tracks the Barclays Aggregate Bond Index. So that's a really good indication of where bonds are, where they've been. This is so far this year. You can see starting January 3rd. And then I also put in SPY, so that's the S&P 500. So that looks at, okay, where are we with the S&P 500? And this is showing on that day, January 4th. So don't get excited about that, because that's showing up. And we can move that. Here's the Dow Jones Industrial Average. On January 4th, that was up 1.25%. And then I have the MSCI, which is a good indication of the global markets. These are very, very broad. Someone may say, well, what about this? What about that? I just want to show you a snapshot. So this is January 3rd as we start, and you can see the colors represent, you know, they've got lines that represent, and they show you where. And as we move forward, we start seeing these drop. And let's see where we ended Friday. So that was 114. So year to date, the bond index, the US AGG, you see there, was down. I didn't check in. Can everybody see what I'm talking about? Raise your hand if you can see what I'm talking about. Yes, excellent, thank you. So you'll see here that the US AGG was down, so that's bonds. Bonds are down 1.67%. The S&P 500, the SPY is down 2.16%. The Dow Jones Industrial Average is down 1.15%, and the MSCI is down 14.03%. So these are certainly the AGG, SPY, and DIA. These are exchange traded funds that track that index. So it's not exactly the index, but it should be very, very close. Just gives you an idea of where we were on Friday, closing Friday, and now it's a little bit worse today, right? So, and you can see the trend lines. Now, just to give you kind of an experience through here, this is year to date I did. Now, obviously 6 month, 3 month, 1 month are going to be the same because it's January 18th. But if you wanted to see a little closer and you went into 10 days, I'm up here clicking, if you can't see my little hand, it'll rewrite the chart for you. Give it a moment. Yeah, it gets a little closer. Oh, I lost all my other ones. That stinks. You'd have to enter them back in. This just starts now with the aggregate index and the, oh, where are they? Are they just not showing? No, they're still showing here. No, they're not. My apologies. What you do here is you type in what you want to compare. So here's the SPY. We'll just give a little look here. Actually, let's get a little tighter. Let's go 5 days, and then I'll build this out again. And you can see, because you can do this yourself. So we have the SPY hung in there with that. We're going to do the Dow Jones Industrial Average. And we're going to do the MSCI. Am I missing one? No. So that's the last 5 days. I think I've got them all. Yep. And you'll see, as I'm moving this around, you'll see that certainly these three are moving very closely together, aren't they? I know it's changing, but the orange, so the S&P 500, Dow Jones Industrial Average, and the bond index, right? They're moving very closely together. You can see by these chart lines. Now, remember that most people use bonds to offset the risk of stock, and that's, this shows one of the dangers of that. So this is an unintended kind of look at this, but you'll see that they're moving pretty closely. Although right here, if we look here, bonds are just in this little snapshot of time here, bonds are a little more stable than the S&P 500 and Dow Jones Industrial Average. I would certainly expect that, but we're down 0.64% compared to 1.96%. So it's still less so far year to date, but if you're down, you're down. Okay. So that's kind of the snapshot. I thought that might be a good way for us to look at that together. And when I'm looking at things, this is a tool I use. And again, I've got great other charting tools, but I just find this one I obviously don't get paid by MarketWatch, but really just an easy kind of tool that anybody can use. You do get ads, of course, but that's okay. We're all used to that. All right. So that's a snapshot on the markets. Now let's talk a little bit about what everybody's saying or what people are saying. So the few that I have this week are, of course, BlackRock, right? BlackRock's talking about rate hikes. So big things in the news, so far this year and at the end of last year, going into the end of last year, interest rate hikes and inflation. BlackRock says it's not necessarily important how much the Fed raises rates. It's the timing of it. Excuse me, they said it backwards. It's not necessarily the timing of the rates, but the sum total of how much they raise rates. So I would say that it's a combination of the two, because if the Fed suddenly said, listen, we're going to raise rates 4 times, and we suddenly jump 1%, I think the markets would take a significant drop, and it may take a longer period of time to climb out of that. My hope is that the Fed is, these are going to be very measured increases, so they can kind of gauge how much they have to put on the gas. I am very concerned. We talked last week about, can the Fed really raise rates 4 times? Jamie Dimon was talking about, I think it was 7 times. People are saying they have to raise several more times over what they're saying. Every time they raise interest rates, the cost of our debt, our national debt, goes up, and we can't afford to pay this debt now. And every time we increase that debt service, it makes it even more unaffordable for all of us. So that is, I don't even think that's really baked into the equation right now, is the future cost of paying down this debt. It's everything else that's baked into it. That's the term we use, general term, just about what's going on in the markets. So the key points that the BlackRock list is, the markets have been rising faster as Fed rates rises, resulting in a rocky start this year. We believe the historically low sum total of rate hikes is key, not the timing. As I said, the stream of fourth quarter corporate results picks up pace this week, with a key question whether companies can keep passing on input price increases. So can they continue kind of that same momentum they had at the end of the year? They talked about the CPI. The US CPI hit a 40-year high of 7% with little market reaction. Yeah. So 7% is a really scary number. I think everybody kind of thinks Well, listen, this is things are costing significantly more year over year. It was really low that last year, but as they continue to see this pain, meats are getting very expensive. Things. I stopped in the store the other day for celery and carrots and simple things like that. I couldn't find celery. Celery, no go. Organic celery anyway, but it just wasn't there. I actually think they're out of celery altogether. So that's weird, right? When you go to the store and you're used to something, a staple like eggs and celery, and things aren't there. We experienced it all during the pandemic when people were hoarding. I don't think anybody's hoarding celery. It's just it's not making its way over here. So that's it's going to be interesting to see as the CPI, the inflation issue unfolds, how permanent it's going to be. Now let's talk about what Bob DiLucia says. So DiLucia is an economist who with Prudential, and he writes some really great articles. He's got 10 points that he says they might be economic surprises that most people aren't talking about it. So he's not saying, he did a Yogi Berra quote at the beginning of the article, and he says, he's not saying this is what's going to happen. He's saying, take a look at this. So the first thing he says, the U.S. economy grows at a rate that comfortably exceeds that expected by most economists. Most economists, I believe, are expecting slower growth this year. Consumer inflation moderates during the year prior to re-acceleration in 2023. Now, I have a little bit of info I clipped in here because he writes, my forecast assumes that core consumer inflation, so what we're just talking about, right, will stabilize at a rate of 4% to 5% over the next several months before drifting lower as 2022 unfolds. So he thinks it's here we are at 7, it's gonna go down to 4 or 5, and it's going to stay there for a little bit, and then it's going to reach down lower. And he's saying he's going to see a temporary bottom of about 2.5%, which is where we've been historically over the past 10 or 15 years or more. But then he said inflation should begin to accelerate once the economy reaches full employment later this year, and in 2023, rising to 3.5% next year, and possibly 5% during 2024. And I would say that he is more of a passive thinker in the way of inflation. Like he's not an alarmist by any means as far as inflation, but he's saying 3.5 next year and possibly 5 by 2024. 5% is unsustainable for a lot of people. So let's hope 5% doesn't become our norm for a while. Productivity grows at the fastest rate since 2010. That's another surprise we could see. Construction of single-family homes greatly exceeds current analysts' expectations. So if we see these homes exceed, which he's starting to see some direction on, then that could help as well. The S&P 500 posts negative returns for all of 2022, following solid returns in the first half of the year. So he's saying this is something that could happen, right? It's unexpected. We could see negative returns for the entirety of 2022. Sounds familiar, right? After solid returns in the first half of the year. Well, we're not seeing that yet, so we'll just see. That's interesting. And he had a point here. What did I say? Most importantly, inflationary expectations could drift higher as the economy approaches full employment, and fears of a more aggressive Federal Reserve could result in a faster rise in bond yields. Yeah. So remember, this is what I was talking about. I hope that the Fed is measured in their approach to how hard they hit the gas and how quickly, because it can get out of control for them. They're not. I think they're very, very good at what they do, but I think sometimes they can be a little bit more measured about it. Any market sell-off during the year is likely to be mild, but would be a precursor of a more severe sell-off in the 2023-2024 period. What else is interesting here? I'm not going to read them all. China's GDP expands at the slowest pace in decades. So that's one of the concerns that, we're raising rates to try to stave off inflation and really kind of slow the markets down a little bit. But China is doing the opposite. China is talking about cutting rates and to stimulate their economy, and that's a big economy. All right, let's talk about how to invest in a down market. All right, so as usual, you're going to see me looking down. I'm going to draw on my whiteboard. Let me just move some things out of the way. First things first. This is a really, you really have to think about your intentions, right? Your goals. I know this sounds very, very basic, but when we're investing, continue to invest. And, we just saw those charts. The charts start here and they're all going down, some sharper than others. But is it really exciting to invest in these markets when it's down here, right? No, it's you hear the term good money after bad. I just open up my statement and I'm putting it, but we know that if you continue to invest, it's going to work out better in the long run for you, rather than, you certainly don't want to be paralyzed by fear. It could be that, this is 2022. We could see this kind of activity for a few years now, right? Negative, sideways, you get a little jolts. And these moderate or modest kind of drops for a longer period of time concern me more than what we, saw last year, where in 2020, I guess it was 2020, when we saw the big drop for COVID, and then we started climbing out. And everybody knows this logically. Again, three years of growth, significant growth with the S&P 500, and that has doubled, right? So you 2 times your money in the S&P 500 over that period of time. So it's not exciting. It's not exciting to invest during that time. So you really have to focus on your goals. What are your goals? You got to be clear about it, and you got to understand why you're investing, because otherwise you could be paralyzed by fear. This is where the planning is so important, and having these conversations, when it can feel really hectic when the markets are down and they're just down and they're down, not even when it's, and probably especially when it's not fast. And that, well, there's probably going to be a recovery quickly, but when it really just wears on you and you're seeing your investments drop time after time again. Now, remember, the worst time that we've experienced so far has been the Great Recession from October 2007 to March 2009, right? So it's about a year and a half. But as I've said before, it felt like it was about 10 years. So you think about before, it was a year and a half of declining markets. Could we see that again? You're darn right. And it could take a lot of time to climb back out of those downturns. So you've got to focus on your goals, and you got to remember what you're doing. It can get hectic. It can feel really depressing. It can feel overwhelming, and you can really get locked up and not know what to do. When I was in law enforcement, when the proverbial stuff hit the fan, we relied on our training and experience, right? You did certain things by muscle memory, right? Because of your experience. So I was fortunate never to be in a firefight, but I know, because I spent so much time training for that my body would just react in certain ways. It's kind of like when you get, to the destination when you're driving, and suddenly you say, wait a minute, how did I get here? I forgot the last 20 minutes I was driving. Your body, it works in certain ways that gets you where you need to go. Being solid about your intentions, your goals, and the steps you have to take is going to help with that, because you have to have a reason for investing. So that's important. So then what do we do? Well, we've got to go back to the fundamentals. You've heard me talk about this hundreds of times. So you set your intentions, you set your goals, and we have to build the foundation, right? Remember, I keep talking about the foundation, and I can't think of a better analogy than those buildings in San Francisco, right? So we have the Transamerica building. I've never drawn this before, and I think it looks something like this, right? So the Transamerica building in San Francisco. So I'm told, and I remember standing on top of the San Francisco Hilton when I worked, on top of one of the roofs, and talking with a colleague, a coworker, and we're looking around the city, and he was telling me about these buildings. So that was in the late 80s, early 90s, I guess. No, early 90s. So it was, the big earthquake out there didn't happen. It was a few years before that. And I was told that the Transamerica building is built kind of on a big ball bearing. So when the earthquakes happen, you get some cracks in your foundation or in your building, but it won't it won't tumble, right? Because it moves. So a lot of the big buildings, or maybe all the big buildings out there, have some kind of mitigation. So if there's a earthquake, then again, they're going to suffer some damage, but it's not going to crumble. So how do you build that foundation so it's not going to crumble? Well, we have our 3 pillars of investing. So if we were live in a class, I'd be hopeful that you could tell me what these are, but I'm gonna write them out for you. But first is asset allocation. Asset allocation. So you got to make sure that your funds are invested appropriately in all the different areas. You know, I just gave you a broad brush of what they are. You know, the S&P 500, Dow Jones, MSCI, the Barclays aggregate bond. It goes much further than that, right? Real estate, emerging markets, larger markets. So, you know, all over the world, we want to make sure that we're investing in all these different areas and investing with the right percentages. So if 20% should be in large companies and 10% should be in small companies, we make sure the fundamentals tell us that for a given amount of risk, right? If this is risk down here, and this is return up here, and using what we call modern portfolio theory, if this is where your core portfolio sits, then for a given amount of risk, you get a certain amount of return. And that's been proven true time after time after time. The problem is this: most people, as you know, they stop there. They say that we're going to invest your money. We're going to make sure that you've got the best components in this pie chart here, and we're going to keep it rebalanced throughout the year. And we're going to make sure that it's performing the best for you, and make sure you've got the best money managers in there, or the best people running these individual things. We'll make sure that it's there for you. So that's all well and good, but what we have to do is we have to draw money out of here during our lifetime, and that's where the problem arises. And then we also have to talk about periods of time. So the first thing, though, you have to have is a strong asset allocation. So how do you overcome these problems of, well, wait a minute, if for a certain amount of risk, let's just use simple numbers, negative 10%, I get a certain amount of return. Let's just call this 10%. And it's not that like that, right? It's not that direct of a trade-off, but I'm just showing you. If you have $1 million in here, well, what is negative 10%? That's negative $100,000. Now, if you need $50,000 to live off of, right? So $50,000 to live, and you have to draw that out of the $100,000. Well, now you're negative, and it's down $100,000. I'm sorry, out of the $1 million. Now you're down $150,000, right? Yeah, because it's the $100,000 that you've lost, market loss, and $50,000 that you've taken out to live off of. And this $50,000 is never to see a recovery, right? You've lost money on this $50,000 too, and now you have to eat it, right? You literally have to live off of it, and it never gets to be reinvested. So that's problem number one with asset allocation, but we need it. We have to have asset allocation as part of our foundation. So how do we handle that? Well, we go to pillar number 2, and that's principal protection. Principal protection. And that is, you determine how much, and the studies have shown that it's usually about a third, right? So 33.33%. you put into principal protection. So your asset allocation lives over here, and that can fluctuate plus 10, minus 10, very generally. Those aren't the real numbers. I'm just showing you. But this is in something that the worst you can do is 0% return in any given year. And on average, principal protection should yield you somewhere between 3 to 3.5%. On a annual basis. So you get less potential returns, but you're never crawling out of that hole. And the studies have shown, BlackRock did a great study last year, that this helps protect your portfolio from the whipsaws of volatility significantly. And not only more conservative investors, but also if we have not only in negative markets, but also in slow growth markets. Now, of course, if we have nothing but strong markets like we've had over the past 3 years, just asset allocation is going to serve you best. But we never know when that's going to happen. So principal protection adds to the buffer of the downside and also helps augment returns in slower growth markets. I'd even say slower growth in normal markets. But that's not enough either. So everybody who does what I do, as a financial planner, financial advisor, everybody does this asset allocation. Everybody says they're gonna give you high level money management, and people do that well, right? Nearly everybody does it well. A good amount of people offer principal protection. The independent planners like myself, a lot of us believe in this. We offer principal protection. That's good. Very, very few people do this next step, and the next step is very vital, and that is account segmentation. And it's really simple, folks. You've got a life to live. So if you're facing retirement right now, let's just use retirement as an example. This may not be you right now, but the goal, of course, is to go from retirement to when you're no longer here. I know you've seen this before, but it's important to go back to the fundamentals, because when things get difficult, and they're likely to get difficult in 2022, you got to rely on your training and your experience. This is your training. We take the principal protection and the account segmentation, and we build on that. So here's your asset allocation portion, right? This is the amount. This is the other amount, right? Just call it, what would it be? Roughly 67%. That is not in, is that right? Yes. That is not in, I don't know why that math is difficult for me right now. What's 100 minus 33? Yeah, 67%. Whew. I have not had my coffee yet. I'm sitting here with a cup of green tea, but I have not had my coffee yet. So that's a 67% that's outside of the principal protection. Most principal protection is not only helps buffer the downside and gives you some growth, extra growth in medium markets, but most of it is set up to help pay an income floor, we call it, to get you some kind of income at some point, 2, 5, 10 years down the road, whatever works for you. But this account segmentation is typically this 67% that's left. Well, what we do is we determine how much money you're going to need in different segments. 0 to 3 years is an example. This is the examples I like to use. 4 to 6 years of your life, right? You're starting today, 2022. If you need to start drawing from your portfolios, 7 to 9 years, 10 to 13 years, and let's just say 13 plus years. So instead of just relying on this one investment and it's going to do plus 10, minus 10, it makes more sense to me, and it works better if you fan out accounts that fit these segments. Let's say you need to spend $300,000 in the first 3 years. Well, we take $300,000 and we put it in a conservative portfolio that is maybe +2, -2. Again, general numbers. So it won't lose much. So if the markets are down over the, what if inflation continues, like Byelich says, or like many of us are expecting, where it's going to be, it can't sustain 7-8%, right? 9.9%. Some kind of mitigation can it happen? Sure. Something has to happen to help set that off, though. But 4%, 5%, 6% is really, really difficult, and it will drive the markets down, I believe. What if inflation continues to be high and the markets then to be sideways or down? Well, we know for the first 3 years, we've got you taken care of, right? We've got $300,000 sitting here. It's not going to grow much, but it's not going to drop much either. Let's just say you need another $300,000 in year 4 to 6. Well, we spin off another portfolio, another account, right? These are separate accounts. And people say to me, well, do they have to be separate accounts? Can't you just combine them all together? You can't, because there is, an investment management, there is math, markets, time, but also psychology, right? There's the psyche of the investor. Happens to me, it happens to you. Nobody is, very, very few people are cold enough where they can just say, you know what, this is what I'm going to do come hell or high water. And I am not going to worry about anything. I'm just going to follow these things and pull these levers. Very, very few people can do that. There's been so many studies about the effectiveness and efficiency of individual investments and the investors in the investments that have much, much lower returns or poor returns, even if the investment is strong. So you've got to overcome the psychology, and having the individual accounts helps that, because hey, the markets are down over here, right? We're going to build out a portfolio over here as well. I'm over here at 13 plus years, and that can be aggressive, right? That can be plus 12%, minus 20%. We're going to get better returns. We're taking more risk. But if you know that $300,000 of your money sits over here, and that's the part that you see drop, and that is account number, 1, 2, 3, 4, for example, and well, geez, account number 1, 2, 3, 4, that can be down $60,000, but I'm not going to need that for 13 years. Well, that doesn't keep you up at night usually. But the money that you need 0 to 3 years is safe and stable, right? You're going to have some fluctuation, but not much. And the money 4 to 6 years, you can be a little bit more aggressive, but still pretty stable. 7 to 9 years, you can be even more aggressive. These are separate accounts, again, because you got to separate it in your mind. That helps you stay engaged. It helps you stay engaged. It helps you not panic, helps you understand what's going on. And you've got to revisit these things, because it's clear for us, but it's these. I often talk about reviews. Reviews is also often about we're reviewing what happened, but we're also reviewing the plan and the reason that we're doing things. So it's almost a re-education every year as well. So this one can be +6, -6. You've all seen this before. This account can be plus 8, -10. However, and again, those numbers are not real, right? You got to use the actual mathematical numbers that show the standard deviation of these accounts. But this is how you bring those pillars together. Asset allocation, make sure this matters, right? Having strong components in these portfolios all the way down the line, that matters. Having part of it protected so it doesn't go below 0 matters. And most of the time what happens is in year 7 and 9, let's just say, well, maybe you only need $200,000 because you've got other money coming in. You might have Social Security coming in. You might have money from a life insurance retirement plan coming in. You might have life insurance from a fixed indexed annuity that offers principal protection, or income from a fixed index annuity that offers principal protection. So you need less money, and this continues. And maybe you need even less money here in year 10 to 3, and then you have 13 plus years. And for many of you, you have a legacy longevity amount that sometimes is in, $500,000 to millions of dollars. And that helps too, because we identify this legacy longevity number and we say, okay, this is money. What if we do this for you? And over here sits, let's just call it $500,000. $500,000 that you're likely not to need over your lifetime. It's there if you need to spend it, but you'll likely not need it over your lifetime. Now, this can be crazy inflation money, right? What if inflation is crazy? This can be long-term care money, right? This could be RV money. Let's do fun stuff. This could be shore house money. It could be a lot of different things, but that's money that you're likely not to need. Not everybody has that, but many, many of you do. And sometimes it's much larger amount. Well, that can be very aggressive, right? So that's another area that can be invested aggressively. Just say +12, -20 again. And that'll grow over time. And we want that to be invested aggressively, because again, that'll be a separate account for you. And you'll know that, well, hey, I'm likely never to need that. That's going to pass on to my heirs, or that's going to be there if I need long-term care, or that's if I want to do something else, or if I want to gift it, that's very, very important. It is so important to identify your goals, what you need in every segment, what your goals are, and the why behind why you're investing. And it's never more important than it is when we're seeing red negative markets. And it can be a while. I entered this business in March of 2001. Markets had already been down significantly. Of course, the towers fell, September 11th, 2001. That dropped the markets even more. We started to see recovery after that, but then we lost faith in our accounting system in the U.S. And we had CEOs getting arrested, and nobody could really count on what was happening in corporate America. And the markets just slid during that time. I remember I was at UBS at the time, and you'd walk around the office and there's different brokers around the office, advisors around the office, and some people had changed the colors on their screens because they were always quoting, right? We had these big quotrons. So they were always quoting, and some people changed the colors from red to green. Instead of a negative showing red, it showed green, just because, again, psychologically, they couldn't take seeing the red anymore. So that was a tough time. The Great Recession was a tough time. We've been really lucky since 2009. We are due for a correction, a significant correction, probably a longer period of time. But you have to stay invested, because we never know what the returns are going to be. And if we're going to have positive returns, we want to participate in those positive returns. But you've got to set your intentions. You got to have your goals. You've got to do your training. Stay here every Tuesday. Listen to David McKnight's podcast. Listen to our special webinars. Stay engaged. Know why we're doing what we're doing. It's very, very important. Okay, so we gave you today. Let me stop sharing that. We gave you today, of course, the slide updates, your market updates for the week. I showed you where you could find those, the market watch and some other. We talked about the CPI. And I gave you some analysts, some feedback on analyst reports. And then we talked about how to invest in a declining market. And it is all about the basics, the fundamentals. Set your goals. Use the 3 pillars: asset allocation, principal protection, account segmentation. That is what's going to follow you or carry you through. And most importantly, you've heard me say it a million times, you have to review this every single year. You got to do your plan every single year. Review it with us on a regular basis. Listen, we want to see semi-annual meetings with our clients. You all know who are clients of ours. We see you more than that. We talk to you more than that. But we want to see at least twice a year to go over this. And then once a year, we go through the whole system again. So I don't see any questions. It is 10:59. It's time for a wrap up for today. If you need to schedule time with me, if you're not an existing client and you have and you don't already have an appointment, you can schedule time. If you are an existing client and you need us, just reach out to us, even if there's no time on the calendar, because there's nothing in January for you. I'll tell you right now, we're going into February. But if you're a client and you need us, call us, send us an email. We'll get you in as soon as possible. Have a great week, everybody. Take care. Bye-bye.